Every other God that there is, with time they will fade away. When the trumpet sound, every other will go. But there is one whose throne is forever. His name is Jesus.
When the bot sends a signal, it would provide stop loss price and take profit price. Now to take the signal, click on trade and then click on the plus, the symbol that has plus at the center, at the top right corner of your screen. The 0.50 you are seeing there is the minimum loss size for volatility 25 as at the time this video was done, this particular video, because this is an old video and now bring it to the present. So that place, that particular session is where you would insert your lot size. Alright, that 0.50. In another asset you might see another default minimal loss size there, because that 0.50 is the minimal loss size for volatility 25 index as at the time this video was done. So that place, that section is where you will select what loss size to use. Is where you would insert the loss size you want to use to open a particular position for any for any asset you are trading. Then where you see SL is where you would insert your stop loss price, which the UptemmaX bot provides. Where you see TP is where you would insert the take profit price, the TP price, which the UptemmaX bot provides. After you have set your SL, that is stop loss price, and then your TP, take profit price, you then click on the sell button at the bottom left corner of your mobile device, and then probably you see modify or something like that. But whatever you see next to confirm your trade execution, click on it to confirm it. Alright, so that's that. Your trade will be opened. Please take note, what you see at the top, what you see currently, that is written market execution. Ensure that that is what you leave as the selected option. Ensure that you select market execution. Market execution means that when you click on sell, the market would open a sell position for you instantly. That's what market execution means. Opening a position, either buy or sell immediately. But since we are dealing with only sell for UptemmaX signals, so when you click on sell, the market would open a sell position for you immediately. So that's what market execution means. So that option at the top where you are seeing market execution, ensure that it's always market execution that you see there and that you select there, because you can select market execution and then select something else that is probably a buy limit, sell limit. You can select any other thing there. I think there's a video on pending orders. So buy limit, sell limit, those are pending orders. So there's a video on how to take signals that I have done using pending orders. But this video is on market execution, instant execution. So I hope you understand. So this is how to take signals. This is how to take the UptemmaX bot signals. Alright, the next video you're about to see will teach you on how to know whether you're supposed to take a trade, you're supposed to open a position, a sell position that the UptemmaX bot would send or not. Alright, so please ensure you watch it. To modify your position, go to trade session, click and hold on the position, click on modify position or modify order, whatever you see there, and then paste your new stop loss SL on the left hand side and paste your new take profit TP at the right hand side, and then click on modify and then confirm whatever you have to confirm to modify the position. Whenever you receive an alert from the bot that says alert, get ready for a signal for whatever asset, note estimated signal time within this current hour. If the current time exceeds this current hour and there's no signal, there will not be a signal sent for this asset until you see this message again. So when you see this alert, the next thing you must do now is go to your chart and locate that asset. Here's the asset, volatility 10-1 index. When you come to the chart, you put the time frame on 1 hour time frame, and then you analyze. You ask yourself if you should open a position right where around the place the current market price is. If you should open a position there, is there a reason for the market to come downwards? Because the bot only sends sell positions, sell signals. It only sends sell signals. So if you should open a position around where the market price is currently, is there a reason for the market price to come downwards? Ask yourself that question. And what are the reasons for the market to come downwards? If you are opening a sell position, if you are opening buy position, then you should ask yourself, what is there a reason for the market to go upwards? If you are opening a buy position, but if you are opening sell position and the bot only sends sell signals, so since the bot only sends sell signals, you should ask yourself, is there a reason for the market to come downwards? Is there a reason? Does this particular chart that I'm looking at has a point where the market would target, the current market price would target, because that point is attracting the market price to itself like a magnet? Is there that point on the chart at that moment? That the current chart that I'm looking at, is there any point on the chart that is capable of attracting the current market price to itself like a magnet, which is called liquidity? So liquidity is like a magnet that attracts market price to itself. So if there's no liquidity when you open a position, or before you open a position, you probably, before you open a position, you did not take note that there was no liquidity, and then you open a position and then you later find out that there's no liquidity, you should close that trade. But if there's liquidity for the market to target, right at that particular point you opened that position, right from that point, you know that after opening that position, after you have analyzed, you know that from that point downwards, the market has a point that it can target, a liquidity point that is attracting the current market price to itself. You know that there is such a point on the chart. Then you should, if you are going to take the trade, allow the trade to go. If you are not yet to put the trade, then you should know that trade will do well. All right. But how do you locate liquidity? This is liquidity point, because these are relatively equal lows. And how do you identify very legit liquidity points? You check, does the current low go below the previous lows? If the answer is no, then that place is a valid liquidity point. Observe this one very well where my cursor is. You see that this low, these current lows, all of these current lows, all of them, none of them went below this particular first low, this particular one that I just later highlighted. This red. You see that none of these other lows went below this particular low, and yet all these lows, they are relatively equal, and they are almost together. They're almost together. So how you identify liquidity is that the lows will be almost together, and the recent lows would not go below the previous lows. Take note. You can put this here on repeat because it's very important. The recent lows would not go below the previous lows, just like you see like this, just like you see here. All of these lows did not go below this first low, so there's a valid liquidity point here. You would even see that you would even see how that there's also a diagonal liquidity here. This place that I just drew a trend line. This particular low now is higher low, and this one is a low, and this one is higher low. So when you see something like that, that's also liquidity. As long as they are joined together, something like this. Let me show you something like this. What I'm drawing. So if you don't know what liquidity is, watch my final class on forex trading that you can find in the UptemmaX community. If you don't have access to it because you are not in my UptemmaX community, it's called final FS something. So something like this. So when you see something like this, if you see something like this is liquidity, but it's diagonal liquidity. So the lows must be closely together. They must be closely together. So there's liquidity right below this low, diagonal liquidity. You get diagonal liquidity. Let me put an ox there so that you understand. So there's liquidity there, and there's also liquidity in relatively equal lows, like you see here. The lows you see here now, they are relatively equal. The lows you see here, where my cursor, look at where my cursor is. The lows you see here, they are relatively equal. And what makes this a valid liquidity point is that, liquidity point is what attracts. A liquidity point attracts market price to itself, and that's the reason why it's a reason. That's why it's a reason why the market will go to that point. That's why it's called a reason. Think about it. So you have to really listen to me on this. That's why it's a reason for the market to come to that point. It's like a magnetic force that pulls the market price to itself. It's a reason for the market to come to that point. It's called, you should know, I'm calling it now for the purpose of understanding, a liquidity point. Let me check whether this is recording. Liquidity point. Liquidity, so relatively equal lows below relatively equal lows are what? Below relatively equal lows is liquidity. Below relatively equal lows is liquidity. I'm focusing on lows because the both only send signals. That's why I'm focusing on lows, because this is what you exactly need. So above relatively equal highs is liquidity. Above relatively equal highs is liquidity. All right. So where, just like I explained here, where there's diagonal liquidity, there's also diagonal liquidity to the upside. For example, let me show you. For the highs now, there's this theory now. There's liquidity. There's liquidity above. So there was liquidity above here. This diagonal liquidity. In terms of highs now. In terms of highs. You understand? In terms of highs. So there was liquidity there. Diagonal. You get? So there's diagonal liquidity. There is relatively equal lows or relatively equal highs that when you draw it involves you drawing a horizontal line compared to you drawing a diagonal line. Are you understanding? So there is a diagonal line we draw for diagonal liquidity. Then when you're talking about relatively equal lows and you're talking about and we are dealing with something that looks like the lows are almost equal in form of horizontal. So you are dealing with horizontal line there. So there is diagonal line and there is horizontal line. Do you understand? So at this point now we are overall we are dealing with horizontal line here. At this liquidity point, we are dealing with horizontal line. So there's massive liquidity here below these relatively equal lows. Massive. Not only there, are you also seeing that there's liquidity here? So there's a lot of liquidity here. If this boat should send a signal for this now, we should be sure that the market price will come to these points. this liquidity point to do what? When the market price comes to a liquidity point, what does it come to do? It comes to clear the stop losses below those relatively equal lows, if you are dealing with lows. So below these relatively equal lows are stop losses of retailers. So when the market price comes there, it comes to clear the stop losses of retailers. So above the highs, the relatively equal highs of above relatively equal highs is liquidity, but and that liquidity is retailers' stop losses. So above relatively equal highs are stop losses of retailers. So when the market goes upwards to clear liquidity at a liquidity point that is stationed above relatively equal highs, what it goes upwards to do is to take out to clear the stop losses of retailers. Do you understand? So, but we are dealing with lows here, relatively equal lows, diagonal lows, horizontal lows that forms liquidity, that are liquidity points, that has retailer stop losses that attracts the market price to itself. That is the liquidity point now. Liquidity points that attracts the market price to itself, and the reason it attracts market price to itself is because they are retailer stop losses that the market price can clear, can sweep. So that draws the market price to itself. So before you open a position, you must check: is there a reason for the market price to go downwards? Is there a reason for the market price to go upwards? Depending on whatever you are trading. If you are trading buy, then you should be thinking about a reason for the market to go upwards. If you are opening a sell position, you should be thinking about a reason for the market to come downwards. Is there a reason? And what is one of the reasons? One of the reasons, and it really major. It's one of the reasons, and it's major, which is liquidity point. Liquidity point. Another reason is order block. So if you don't know what order block is, watch my market structure video. All right. So another reason is order block, but liquidity is the boss. Liquidity point is the boss. All right. So you check: does the market have a reason to come downwards? If it has, and you open a position, you should be rest assured that the market would come downwards. So there are two liquidity points here. 1, 2. So the market will surely come downwards if a position is opened right around here. For me, the one who has the both running on his account, but for the Telegram, they both send signal to the Telegram. All right. So you understand. So this is the main reason for the market to come downwards. Another reason is that a reason why the market price might not come downwards is that, let me show you. You might probably zoom upwards. You might probably zoom like this, and then you check. You draw your line. You draw your what's it called? Your trend line. You draw your trend line, and then you check. When the boss sends a signal, where is this boss sending a signal from? Is the boss sending a signal from a support zone of a trend line of a market that is on an uptrend, that's already on an uptrend? Look at it. This market is already on an uptrend. The market is already on an uptrend like this. So you must check where, because when the market is on an uptrend, it makes what? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So when like this now is this is a low, and this is a higher low, and this is another higher low. So in an uptrend, the market keeps on making higher lows, higher lows, higher lows. So you must check. When you draw your line as a retailer, you must check where is the bot wanting to send the signal. When the bot sends the signal at this point, what are the potential dangers of entering the trade? Now, if Probably let's say the boat sent a signal right here where my cursor is currently, and then it at that point is a support zone, is a support line for a market that's already on an uptrend. So you understand how uptrend works, where it creates higher lows, and then you see the boat wanting to open a position here. You will know that no, this trade is dangerous. So you will then come to the optimal signal group and then take a screenshot and then drop your opinion why this trade is not going to go well. And if you know that the trade is going to go well, also take a screenshot and then come to the group and tell us why you think the boat is going to go well. Now imagine, see another thing. Imagine in an uptrend, the boat then signals that it wants to take a trade here, just like it did. I think it took a trade here, right here where my cursor is. Look at where my cursor is. It took a trade here. Now, because we know for a fact that in an uptrend, the market creates higher lows and it creates higher highs. Now, it has already created a higher high here. It has already created a higher high here. It then means that we are expecting it to do what? Higher low, to create a higher low. So having that understanding, and then you are seeing that the boat wants to open a position here and send a signal here. It sends an alert first, and because it sends an alert, you have an opportunity to come to the chart. So when you come to the chart and you are seeing something like this, you would have confidence that when the boat sends a signal and you open, when the boat sends a signal and then you open a position right where my cursor is now, the market price has a tendency of coming downwards to the support zone of a trend line that you had already drawn in the past, which signifies a support line for an uptrend higher low that is being created. Like I said earlier, this is a low, this higher low, and when the market, this is low where my cursor is, and this is higher low. So when the boat sends a signal here and then you open a position, there's a confidence that the market price ought to come to this line to touch it. Are you seeing it? And remember, I talked to you about liquidity previously. If you look at the left hand side, now imagine the boat sent alert at this point and you came to the chart. Look, what would you have done? You would have looked for a reason for the market to come downwards. And what is a reason for the market to come downwards? Now look at the left hand side. Let's do this. Look at the left hand side. Was this liquidity? I'm not sure this was liquidity, but that's not what I wanted to show you. Look closely. If you look further to the left hand side, you will see a diagonal liquidity right here, closely together, closely packed lows, closely packed relatively equal lows. Look at it. Let me zoom in so that you see it. Look at it. Let me take this to upwards. So are you seeing it? So there was liquidity here. I don't know why that is not moving. Let me use this one. So there was liquidity here. Right when the boat signaled that it's about to open a position, it's about to send the signal for you. Then for me, it's about to open a position. Although I don't need that alert, but let me just say it's about to send the signal. And then it later open a position for me, and then send the signal to the Telegram group. So right before it sent the signal, if you had come to the chat, if at that moment you were available, when like you were taking the signals at this point, if you had come to the chat, you would have looked to the left hand side to look for liquidity, to look for a reason, like I said, a reason for the market to come downwards. Look for a liquidity point would attract the market price to itself, a magnetic force. So if you had come to this chart, you would have found this is liquidity point. So there's liquidity below these relatively equal lows diagonally. This diagonal liquidity, relatively equal lows that are diagonal, closely packed lows. So there's liquidity there. So you have confidence that the market surely should target this liquidity that is here. And let's see if it actually targeted it. Now remember, in a market that is going upwards, let me not say remember, in a market that is going upwards, you should be careful. In a market that is going upwards, you should be careful, because even if there is liquidity here, because the line that you drew, because you can even see, because the line that you drew previously based on previous higher lows does not get to this point, the market price is most likely not to come to this liquidity to clear it. It will stop at the trend line. So you should take note of this. Look out for liquidity point and also be good at drawing trend lines for a market going upwards and for a market going downwards. Like this. For a market going downwards like this. I don't know why the network is like that. So for a market going downwards like this, let me show you. So for a market going downwards, you are looking out for the market creating what? You are looking out for the market creating lower highs. You know, for an uptrend, the market creates higher highs and higher lows. Higher highs and what? Higher lows. So if you don't understand this yet, go watch the market structure video. Watch the market structure video I've done previously. I talked about higher highs, higher lows for a market going upwards, and lower highs and lower lows for a market going downwards. So for a market going downwards, the market creates lower highs and lower lows. So what you'll be looking at to trade is when you would have confidence in a trade is when the market goes upwards. Like one of the ways you would have confidence in a trade is when the market price is when the market goes upwards and then creates a lower high, or it goes upwards to touch the upper side of the line that you have drawn for a market going downwards. This upside, just like you draw a line for a market going upwards for higher lows, you can even decide to draw a line for the higher highs, like I did here. I started from this point. So you can do that for a market coming downwards. You draw a line for it for a market coming downwards. You draw the up line and the down line. So when the market's at the upside and then the both sense an alert at that point, or no, when the both sense an alert, and then you come to the chart and you observe that the market price is currently at the upside of a descending channel. You can check at descending channel and ascending channel. So for a market going upwards, you can see ascending channel, and so you can see ascending channel, then the market coming downwards, descending channel. So when you see that the market price is currently at the upside of the descending channel for a market going downwards, that would give you confidence. And because you have an ideology, now you need to listen to me carefully on this. In a market going downwards, the market creates lower highs and lower lows, which then means that after it creates lower high, the next thing it will create is a lower low. So if this was a trading view, it would have been easier if I used the tool called part 2 or something like that. So I think the bot will soon send a signal. It will soon send a signal. They open the trade for me. So look at this. This is what I want to show you. Everything worked perfectly. So look at it. So let me move this line to this point. Look at it. So this is where my cursor is now. This is high, and then this is lower high. So after a lower high, the market creates a lower low. So this having this ideology that in a downtrend the market creates lower low, after it has created the first high, it will then create after it creates lower low, it then creates lower after it creates lower high, lower high, it will then create lower low. Then after lower low, it will create what? Lower high. And after creating lower high, it will then create another what? Lower low. So having this ideology, and then you draw your line based on that, you will then know where your TP should be. You will then know where your TP should be. So if you enter at this point, you would have the confidence that the market will surely get to this previous low. Because why? When the market creates a lower high, the next thing it does is that it creates a lower low, and that lower low is that it goes below the previous low. So for a market going downwards, for a market going upwards in an uptrend, I already explained to you that because you know that the market, you have already drawn a line. You already draw a line using lower highs, using higher lows. Using higher lows, and you know that the market would. I don't know how I explained it, but the same ideology that I explained for this descending channel, for this market coming downwards, is the same ideology, similar ideology you would apply for uptrend. So you know that the market price is most likely to touch this line that you drew using previous higher lows. So when the boat sends a signal, you open that trade, you should target what? That line. It doesn't matter if liquidity is below. Now, how you should do it is that you should always put your take profit price above liquidity. So for this point now, if the boat open this trade now, when it sends a signal, I'll put my take profit above this liquidity. So I'll put it here, but I'll put it above this other block. So this is another block. These two candlesticks you see here. These two candlesticks you see here. This small red candlestick and this green candlestick. You would observe that this green candlestick overshadows this red candlestick. So this is called another block where the current other block, where the current candlestick overshadows the previous one. So, and the previous one is a small candlestick, and then the other one is big. So probably I know why the boat is not taking the signal for now. It's not going to send the signal. Probably I know. So I'll put my take profit here. I'll put my take profit here above the eye. Look at where my cursor is. So look, for this small candlestick now, this is another block. These two candlesticks joined to combine, the long one and the small one. So I'll put my take profit above the eye of the small candlestick, above it. You understand? So I know that the market will surely target the liquidity here, below it. But when it comes here, other block is also a point to take note of. When market price touches other block, it can temporarily retrace, and probably it can even reverse. So knowing that other blocks is capable of making the market price do that, either retracing or reversing, I'll put my stop loss, I'll put my take profit above that eye. You understand? So another thing is that you use this ideology to determine if the trade is safe or not. So draw your lines and understand where is liquidity point. Draw your lines, understand where is liquidity point. Identify an uptrend, identify a downtrend. Draw your lines, ascending channel, descending channel. This is called ascending channel, where the market is creating higher highs and higher lows, higher highs and go on. If you don't understand, watch the market structure video. higher high. If probably that's the first high. It creates that first high, then it creates a higher low, then it creates another high that's higher than the previous high. Then it creates a higher low. The higher low does not go below the previous low. That's why it's called higher low. So for this now, the higher low does not go below the previous low. That's why it's called higher low. But for a downtrend, a descending channel, for a downtrend, the market is called lower low because the next low must go below the previous low. Just that the lower highs of a market going downwards of a downtrend, the high must not go above the previous high. So for a market going upwards, the high go above the previous high, but the low does not go below the previous low. The high go above the high of the previous high. The high go above the previous high, but the low does not go below the previous low for a market going upwards, for an uptrend. Then for a downtrend, the low go below the previous low, but the high does not go above the previous low. Like we see here in this one I drew here. So the high does not go where my cursor is. The high does not go above the previous high, but the low goes above the previous low. So you draw your lines, understand where liquidity is on the chart, understand the dangers. Alright. So another thing is that if the bot should attempt to take a trade here now, and then you observe that there's liquidity above, you've seen, just like this liquidity point we identified, this is massive liquidity point. Although the bot did not send a signal here because probably there are some parameters that did not get to meet, probably, but you'd observe that this is massive liquidity point. So if you find something like this above a place where the bot wants to take a signal, if you find something like that above, then that's a potential danger, because the market is most likely to go upwards to clear the liquidity there. It's a potential danger. Or the market, or you find the market, like, I don't know if I explained this earlier, probably I did, where my cursor is, or you find the market, you find the bot sending a signal right here, where you know that at this point the market price has created another higher low, and after it creates another higher low, what is it supposed to do? It's supposed to go upwards. So you know that from this point the market ought to go upwards, and you are seeing the bot wanting to send a signal at this point. So you know that it's dangerous. So those kind of things, what you should do is that you have to take note, you have to get a note and jot down all what I've said now, because this will really help you in knowing what is dangerous and what is not dangerous. Alright. So yes. Yeah. Another thing, probably you should watch out for that one also, is probably when you see this for experts. If you don't know what that block is, please go and watch other block. Go and watch the market structure video. But is that other block even necessary to talk about? Let me not talk about that. So you can add to what I've already taught you now. You can add to it. You can improvise, add to what I've taught you and what you already know, to then come up with ways to know if a particular market should not be entered. So for the stop loss, so you always put your take profit above the liquidity point, or in a particular point. Like for example now, this particular point where there was liquidity here, where my cursor is, but then you see that the market, there's a line here, so this line will prevent the market from coming downwards to clear liquidity. So you should have at this point where the boat took a trade here, where I should have put my take profit is before the line. You understand? Before the line. So that's how it is. So come up with other ways to know if a trade is dangerous or not, from all what I've taught you or based on what you already know. So this is how to work with the boat. So before the boat sends a signal, it first alerts you. So by that alert, you should quickly analyze and know if you would take the signal that the boat will send or not. And if you know that you're not going to take it, take a screenshot and then bring it to the group and then tell us why you're not supposed to take it. And if you know that you will take it, take a screenshot and then bring it to the group and then tell us why you will take it. So I want this to be a community-based I want this to be a community-based signal taking, based on the community, based on the members of the community opinion. So everyone should drop their opinion concerning what they think about the current state of the market. Should they enter or should they not? Should they enter when the boat sends a signal or should they not enter? They will come to a conclusion. So that's it.